Hey, good morning, everybody, and welcome to this Tuesday, July. I think July is long gone. Tuesday, August 5th, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again today. Market bounced back pretty nicely yesterday. We'll go through a lot of the numbers, but not only was it a solid bounce back, but I thought the underlying strength was pretty solid as well. So I'm still in the camp that I think we're consolidating and coming off of a top. But I tell you what, if we keep moving up the way we did yesterday with the strength, the underlying strength that we saw, I don't know, this selling may not last very long. We'll see. I'm going to go ahead and jump in though and just start taking a look at what happened on Monday to give us a good sense of maybe what we might see later today. But the Dow Jones yesterday gained almost 600 points, 585 points, jumping 1.34%. The S&P 500, I know we got over 6,400. We had a pretty big drop on Thursday, or reversal on Thursday, and then a big drop on Friday with the lackluster jobs report. But we quickly got back almost 100 points on the S&P 500 yesterday, gaining 1.47%. And only about 1% now, a little bit more than 1% below another trip to 6,400. So we'll see what happens here. But again, the action yesterday was pretty bullish from what I saw. NASDAQ gaining almost 2%. So there's that relative strength in the NASDAQ shares, which is always a positive. The small caps, mid caps saw returning strength. And that was a group that had really, on a relative basis anyway, I thought it had been pretty weak over the course of the last couple of weeks, maybe 2-3 weeks. But that group bounced back as well. And after having a rough start, small caps actually outperformed the rest of the market, the balance of the day yesterday. So not a bad day in the small cap area either. And to look at the VIX. Remember last week we finished the VIX up in the 20s, and I thought, okay, well, maybe we might get a little bit more of that impulsive selling. It's hard to say exactly how fast you might drop when you get a VIX that goes up in the 20s. Yesterday dropped 14%, came right back down to 17.5, and that's good news for the bulls. I mean, we want to get that volatility index back down. That's the signs of a continuing secular bull market advance. So all in all, I really would not have expected the strength that we saw yesterday coming on the heels of what we saw at the end of last week. But this is a new week, and the market, seemed to like what was going on yesterday. So we'll see if we can continue that short-term winning streak. Underlying the strength yesterday was rotation into some of the key areas like technology and communication services. Technology gaining more than 2% yesterday. Communication services 1.92%. So that was really good to see the strength coming in back into those couple of key high growth areas of the market. That's what we want to see. That anytime the market's moving up, we want to see that commitment. We want to see folks being more, investing with more of a risk on kind of a mentality as opposed to risk off. And anytime you see technology, communication services up at the top of the leaderboard, that's generally going to mean that we are in a more of a risk on kind of mode. So again, I thought the action yesterday was pretty positive. And considering now that the earnings season, most of the key earnings reports are now behind us, we'll still have some big ones. Last night, we got another nice report out of Palantir, PLTR. I'll go through that chart with you in a little bit, but Palantir adding to the strength. I think stock was up maybe about 5% after hours, something like that. We just continue to push to the upside, even after the selling that we saw at the end of last week. So let's take a look at the indices and see what's going on there. Because honestly, last Thursday and Friday was I would say without question, the worst 2 days that we've seen back to back since early April or mid-April, since we climbed back above the 20-day moving average anyhow. Last Thursday wasn't bad to start. Remember, that was when we had Microsoft and Meta come out with blowout earnings reports. We got these big gap ups. Meta gapped up, I don't know, $80 or whatever it was at the opening bell. Microsoft also big gap up. But then we saw selling, not only in those two stocks, but in the overall market after getting a really nice gap up. We saw a lot of selling. We saw volume increase. It was one of the bigger volume days of the last month. Actually, it was the largest volume day in the month of July. And the reversal took place. And so, gapping up and right at that open, let's take a look here. I believe the high was or the open was the high of the day. Yeah. We didn't go up 1/100th of a point after that opening bell. 64.2702 was the open, and that was literally the high of the day. So the selling took place all day. You can see it was an engulfing type of candle. We gapped down on Friday with the weak jobs report, down below the 20-day moving average. And with negative divergences in play, there's nothing to say that this doesn't morph into a 50-day test. So you can understand there was a little bit of trepidation going into Monday, and yet we gapped up and we saw buying all day long. I mean, there was almost no signs of what we saw last Thursday and Friday. It was like a completely different market environment. So it was unusual. We're certainly not out of the woods. I think we've still got clearly the top. That 64.27 number is going to be a big number now. If you recall, let me pull up the semiconductor group. And I'm going to go back a little ways. Let's go back 1.5 years. I think that should do it. Right here. This was back in June. Remember, the semiconductors had made a huge run, and then we gapped up to 21,000 and then printed this massive reversing candle. After gapping up, we had no more strength off of this uptrend. And then we printed this big volume candle, and it was a big reversal. And I said, okay, this is the top. This is a major top on the semiconductors. And you got to be careful until we get a breakout. And you can see what happened after that. I mean, we got up to 21,000. We did have a couple of false breakouts. That would have been easy to fall for sure. But outside of that, I mean, we really didn't get another breakout until a year later. It was June, almost to the day, 1 year later, when we finally got the breakout that actually lasted. And we continued pushing up off of that. So these types of candles, just understand they can have, I don't expect this to be a long-term top in terms of a year. I really don't think that at all. But I could see it being a late summer top, what we saw. So let's go back now and let's look at that S&P. So there is that reversing candle. Well, that's the semiconductors, which also had one, by the way. There is that reversing candle, though, on Thursday, and then the gap down on Friday. So yesterday was a good day, but we haven't done anything technically other than climb back above the 20-day, which is not a small thing, by the way. It's nice to see us move right back up above. You can see we've had false breakdowns on the 20-day moving average before, and we've reversed off of them. And that's led us to, here off of this reversal, we had a big move. Here off of this reversal, big move. Here off of this reversal, big move. I'm not saying we can't go up and take out 64.27, but we do have a target now. In the past, last week, we were just going up into blue sky territory. There was really nothing overhead. We didn't know where the next resistance level was. I now know it's 64.27. So can we get back through that level? That's going to be key. We got another 100 points to go on the S&P 500, which would be about 1.5%. Can we do it this week? I don't know. Can we do it this month? We're going to find out. But I do think we need to respect that level. So personally, my strategy during this strength, I had already started building cash last week. And the remaining positions I sold some of them yesterday into the strength. And I imagine if we continue to strengthen, I'll end up selling some more today and working more and more towards cash. And if we can get through 64.27, I'll jump back in, most probably with ETFs in the market, probably not too many individual stocks. But I got to see the breakout. Otherwise, I'll be perfectly content sitting back with a little bit more cash or a lot more cash and just kind of watch and see where we go. Keep in mind a couple things. This is important from a historical perspective. July 17th to September 26th, I talk about it pretty often. Many of you probably know this by now. July 17th close to September 26th close is the worst time of the year historically for the market. That's not my opinion. That's not what I read somewhere. That's not what somebody told me at the water cooler. I got a spreadsheet. Those are facts. Since 1950, that's the worst period. July 17th to September 26th, close to close. Now, that doesn't mean the market goes down every day of that period, every year. It just means that that's a tendency. There's a tendency. So, with all other things being equal, we should at least keep in the back of our mind that history is not on the side of the bulls over the summer months. September is the only month that has gone down more than it's gone up since 1950. August is not as bad as September, but the second half of August does start to turn more bearish. And those 2 months, August, September combined, are the worst two consecutive calendar months of the year. So let's just understand that we need to lower the bar just because of history. We know that this is a time of the year when the market can struggle. Doesn't mean we're going to struggle. September, even though it's the worst month of the year, I think there's been like 33 Septembers since 1950 that have gone higher. 40 have gone lower. Or maybe that's only 73 years. So there's a couple more. Maybe it's like 34 and 41. I have to go back and look at the numbers, but that's basically the ratio. So there are still a lot of Septembers where we go higher. I don't want anybody to think, oh, this is the worst time of the year. Market's going to have this massive sell-off. That's not always the case. However, we do get some pretty big sell-offs in the summertime from time to time. We saw, I think, let's go back here on a couple of years. Let's go back a few years. So right here in July and August, this was last year, mid-July, almost right on the 17th. I mean, you can't make this stuff up. All the way toward the end of September. I mean, this was the period we struggled last year. If you go back the year before, the end of July started a 3-month 10% correction. Now you go into July of 2022, and of course, we were already in a cyclical bear market. And that was the year I called the bottom on June 17th, I think, of 2022. And the S&P 500 rallied 700 points and started to roll over. And then right about at the end of the month, it was August 25th, Friday, or maybe 26th. But I know it was on a Friday. It was the Jackson Hole speech. If you recall, that was where Fed Chief Powell talked about more pain ahead for the market. And that started one more slide where we ended up going down slightly below that bottom that I had called back in June of 2022. And we've got that Jackson Hole speech coming up, by the way, later this month. What is Powell going to say? Your guess is as good as mine. I have no idea what the man's going to say. Anyhow, you can see though, but then that was August, September. Look at the month of September back in 2022. Back in 2021, actually, it wasn't bad. Most of the summer was going higher. We did pull back during the month of September, but otherwise wasn't a horrible summer. So it doesn't mean that we're going to pull back. But when you look at the S&P and you see at the end of July, we're starting to roll over here a little bit. And I go back and I show you some of these tops in the summer, and you know the history of the market. We can't just assume we're going to keep going higher. I also showed, I think it was in, I don't remember if it was in the article I wrote last weekend at StockCharts. And by the way, if you are over at StockCharts and you want to follow my articles, they've kind of changed things over at StockCharts. So you go under articles and videos, and you can click on my name for authors, and that'll pull up all of my articles. If you go to latest articles, though, you'll have to probably scroll down to find what you're looking for. So here was an article that Carl just wrote yesterday. Here are a few featured articles, and then you come down and you have to go down the list to find the latest. There was one that I wrote over the weekend. It was actually, I think it was published on Monday morning. I wrote it Sunday, but I think it actually got published Monday. But you can go and check that out. Now, what you can do is if you click on the article, there should be a spot, unless they change that. Well, I don't see a place where you can sign up. Let me just go to here. No, I guess you can't. I don't know. Maybe they're not sending out emails anymore. Although I think I received an email when I wrote an article. Anyhow, I'm not seeing a sign up. There had been a place where you could sign up and just put your name and email address in there. And if I published an article, it would automatically be sent to your email. And there was no cost for that. But I'm not seeing that. And I don't see any place to sign up now. So I don't know. Maybe they took that away. Anyhow, I'll have to double check with StockCharts to find out what's going on with that. But that's how you go in and you find my articles. If you go over to the articles and videos, just click on my name or find my latest article, pull it up, and then you can click on my name here. That'll bring up all the prior articles you can go in and check out. All these articles I write over at StockCharts are free. So feel free to check that out. Most of the time I publish on the weekends just because I have a little bit more time on the weekends to publish. But occasionally I'll publish during the week as well. All right. So let's move on. I wanted to show you another chart of the S&P 500, but on this chart, I want you to look at the sustainability ratios. I like to call them sustainability ratios. They're just different growth versus value, or offense versus defense type of ratios, intermarket relationships that normally will go higher when the market is going higher. That's what we look for. So for instance, you can see down at the bottom here at the low in early April in the S&P, we've been rallying off of that. If you look at the QQQ versus the spider, which the QQQ represents the NASDAQ 100, which it's just a little bit more growth oriented than the S&P 500. So it's just giving you a little bit more of growth flavor versus value. And you can see that's been going up, coming off the April low. It went up pretty quickly, kind of slowed a little bit in July, and we're still okay. That's why I'm saying yesterday we bounced back up. We're not far from setting a new high. So it hasn't been that bad so far in terms of relative performance of growth versus value, at least when we look at the QQQ versus the spider. Next, XLY, XLP. We pulled back at the end of July a little bit, but overall, I think we still have a nice uptrend in play here. I still like this. I think that's a good sign. You know, if you look at when the market topped, which was right back here, actually our high close was, I think, a little over 6,400, which occurred over a week ago. It wasn't last Thursday. Last Thursday was the opening and the intraday high, but the closing high actually came about 3 or 4 days earlier than that. And at that high, you can see the XLY, XLP was at a high. So there was no selling off ahead of that high, which would give us a clue maybe of some additional selling that's going to be hitting the market here in the near term. Didn't really see any of that. I mean, if you go back and you look at the top in February, you can see that the XLY, XLP topped in December and January. And by the time the February high rolled around, that was starting to fall apart. We were at like a 2.5, 3 month low on the XLY, XLP. And even during the December through February period, we saw the QQQ going down relative to the spider. We did bounce back up in February, but we were not able to set a new high. And then we just continued spiraling down with that cyclical bear market, that quick one that we had February to early April. But look at all these ratios. So here's the discretionary versus staples. Here's large cap growth versus value, IWF versus IWD. This is another large cap growth versus value. It's the Dow Jones US large cap growth versus Dow Jones US large cap value index. You can see it's pretty similar to the IWF, IWD, which it should be, because that's what the IWF and IWD are. It's the Russell 1000, which is the largest 1,000 companies, growth versus value. And so we're getting growth versus value going up. How about mid cap growth versus value going up? Small cap growth versus value at a 52-week high, not breaking out, but since topping back in, what was that? June, May? That would have been back in May here. Since topping in May, we've just kind of gone sideways. So growth has held up fine versus value. The only thing really that's turned down, and that was fine up until the Fed meeting last week, is transports. Transports completely fell apart last week. And if you understand what drives transportation stocks, this should concern you. It concerns me. I don't like to see the transports falling apart. I think the transports were starting to rally on an absolute basis. They were also rallying on a relative basis to utilities because I believe the market was thinking we were getting closer and closer and closer to rate cuts. And last Wednesday, I think Powell basically just tried to put all that to rest. He said, nope, no change this month. And no, we're not really talking about it for September at this point. And so that kind of squashed a lot of folks that, the market was anticipating a rate cut. The odds were that we were going to get a rate cut in September. So when I see this happen to transportation stocks, that tells me that the market was just throwing their hands up in the air saying, I don't understand what's going on with this Fed, but they're not going to cut. They don't seem to want to cut. And therefore, I'm getting the heck back out of transports. And we saw the same thing with small caps. We saw not very good action on the KRE, which is the regional bank. Look at the KRE falling back. I mean, it barely budged back to the upside yesterday. So we've still got issues out there that haven't been resolved. It is interesting that on Friday when the jobs report came out, and I know it was all over the news, Trump fired the Labor Bureau Statistics or Bureau of Labor Statistics. The head of that, he fired her, claiming manipulation. I didn't see him actually saying it, so I don't know if he was claiming manipulation or not, but that's what was in the news. I will just say this, and this maybe comes from a place in my past. I'm a former practicing CPA. Numbers need to make sense to me. The numbers need to be accurate. The numbers need to be right. I don't like this. Well, we're going to adjust our numbers from last month and 2 months ago and 3 months ago. There were some major revisions to the non-farm payrolls report. Not, for July, it was reported weak. But remember, we had good reports back in June and in May. Very solid reports that made us believe that the economy was remaining very resilient. Well, on Friday, those reports were completely revised lower, way lower, to the point where we barely had positive jobs numbers. So this is the third month in a row. July was the third month in a row of pretty weak job numbers. And I just wonder if that data, if all those revisions, maybe the Fed had it on Tuesday and Wednesday, I don't know. But if they didn't, it would certainly be interesting to see how differently maybe that meeting might have gone with those better numbers or with those revised numbers. And again, it's probably the CPA in me that says, why in the heck are we still revising May numbers? Is our system that bad? I mean, we're in a day and age in technology where we shouldn't be going back and revising by huge amounts of numbers May reports. We're in August, folks. Why are we still revising May? So I kind of get it from the standpoint of why are the numbers so far off? Now, what I don't get, what I talked about over the weekend was I don't believe it's any kind of manipulation because there are hundreds of people that work on these statistics. I don't think one person's going to be able to just come in and say, oh, well, it was only going to be 14,000 jobs, but I just put a 2 in front of it. That can't happen. So I don't believe in that it's manipulated. I just think it's poor accounting. And so how do you make these decisions? How's the Fed supposed to make good decisions if the data coming out's no good? That's where I have the problem. And again, it stems back to my, my CPA days being in public accounting. I mean, I try to get everything as perfect to the penny as possible. So to me, this is just unacceptable to have numbers that just don't make any sense and that are going to get revised in 2 or 3 months. The market's trading off these numbers. They need to be right. Anyway, that's a different rant altogether. But again, I don't think they're manipulated. I just think it's poor accounting. And maybe the person at the top is responsible. That's usually who's responsible. Anyhow, so when you're looking at the numbers, and what I'm looking at is a market that seems to have topped, that obviously took a big hit last Thursday and Friday. Thursday was a pretty bad day to get that kind of great news on Microsoft and Meta and have all technology and all these different areas of the market gap up and then completely sell off all day long on big volume and then gap down the next day on poor economic news. That's kind of the way a top forms, especially a short-term top. We needed something. And so I think we kind of got it. It was like an exhaustive rally. So if we go back and we take a look at that S&P 500 again, and I've spent a lot of time on this, but I think it's kind of important. That was a big, big deal. 64.27 now is a big level for us. To the downside, remember we had the breakout above the February high at 61.44. That clearly is a support level. Anytime you break resistance, that becomes support. 61.44 is a support level to watch. The rising 20-day, we've already gone below it and back up above it. So I'm not even sure the 20-day matters to me at this point. 61.44 matters. And with a negative divergence, many times we'll see a 50-day test. And that 50-day on the S&P 500 right now is at 61.39, which is very close to 61.44. So I'm going to say the 50-day moving average is our support and 64.27 is our resistance. I think that's the range we're in. And so, yes, yesterday was a really good day. I know futures are up. Let me give you the futures. Or they were up. Let's see, diamonds. Diamonds are relatively flat. They're actually down just a tad. The spider is up 5/100ths, half of 1%. Not much there. I think futures have come back down a little bit. The QQQ is up 0.2%. So we're getting a little bit of movement there. And that's maybe somewhat because of Palantir, which I'll show you that chart here in 1 second. And then the IWM small caps actually were doing best. They're still up about 0.3%. So we're getting a little bit of additional movement to the upside in the IWM this morning. So, futures are okay. And like I said, we had Palantir coming out. So let me give you the latest on Palantir, up $11, 7%. So really, really good action there. We had two of our portfolio stocks that reported yesterday after the bell. One is ThreadUp. You can see a stock up $1.35, $13.95. This is in our aggressive portfolio, which is absolutely killing the S&P 500. And I'll show you how you can become part of that here in just a second. Let me show you Axon, which is the other. This is up $66, another 9% here. Both Axon and ThreadUp they're two of our 11 stocks in our aggressive portfolio. Our aggressive portfolio is absolutely on fire. Let me show you the numbers. I didn't update the ETF. I didn't get to that yesterday, but I did update our portfolios. And the S&P this quarter, and when I say this quarter, I'm talking about our fiscal quarter at earnings beats, which is from May 19th to August 19th. Every one of our quarters are right after earnings season. So August 19th, once we get through these next couple weeks of earnings, we'll have another portfolio draft where we will fill out our portfolio for the next 90 days. Anyhow, from May 19th to August 19th, the S&P 500 is up a little more than 6%. This quarter, our model is up 11.14%, and our aggressive is up 23.56%. That's 17 percentage points above the S&P. And oh, by the way, two of our 11 stocks, I just showed you, Axon with earnings up another 9%, and Thread up 14%. So it's going to start off to be another great day for our aggressive portfolio. Now let me go back over to the home here, because I do want to point out a couple of things. Number one, if you want to just become a free member at Earnings Beats, name and email address to our Earnings Beats Digest. We'll get that to you. We'll get you started on that. There's tens of thousands of folks that have joined us on there. Why wouldn't it? It's free. It's free education, some stock trading tips and so forth. Feel free to sign up there. Also, this is big. I want you to sign up for Saturday's event. We have an event coming up this Saturday, 2 steps to better stock picks. You just saw our performance. I mean, we could go and I could show you again. Let me show you our inception to date returns over here. The S&P 500, since we started the model portfolio, is up 135%. The model portfolio is up 323%. The aggressive portfolio is up 209% versus the S&P's 121%. We are very consistent. We do the same. We go through the exact same process every quarter for this. I mean, if you want to learn how to pick better stocks, sign up for this event. All you do, come to our website, earningsbeats.com, click on this. It will bring up this landing page, put in your name, email address, and hit submit. And I'll see you next Saturday morning. Well, this Saturday morning, Saturday, August 9th, 10 a.m. It'll be no more than 90 minutes. I'll try to make it 60 minutes, but no more than 90 minutes. And I promise you, it's going to change the way you look at stocks and the way you pick your stocks, and hopefully for the better. So make sure you check that out, sign up. Even if you can't make it on Saturday, still sign up, because we'll send you a copy of the recording. Anybody who's registered will get a copy of the recording. And then we'll give you instructions to join us on Saturday morning. But we'd love to have you. And I think it's going to be a great event and a timely event, because earnings just coming out. We're going to be restocking our portfolios in 2 weeks. Now's the time. I'm doing all my homework right now to try to find the best stocks for the next 90 days. All right. Let's go back over here for a minute, and let me pull up Palantir. And let's just take a look at the chart. It's now 9:30, 9:32 actually. So we just opened. Palantir now up $14, almost 9%. Another huge move. And the thing is, when you look at Palantir, it is one of the leading stocks in software, and software is one of the leading areas in the market. If you know one thing about the stock market, leading stocks and leading industry groups will produce returns that beat the S&P 500. And we'll talk about some of that on Saturday as well. But great reaction there. Let me just look at the TDUP coming back down after a gap up to 1084 on the open. And Axon, AXON, wow, up $125 now. It's up 17%. So a huge start to the day for AXON and also for Palantir. Let's take a quick look at the market, see if the market's gaining ground. Actually, not really. We'll go to the intraday. QQQ up just a little bit. Spider up just a little bit. Diamonds strengthening a little bit. And then the IWM coming down a little bit from the open, but still showing some strength there as well. So overall, I mean, the market definitely rallying, but watch the S&P 500 64.27. That's going to be a really big level for us. All right. That is it for me for today. Appreciate everybody tuning in. Market, let's be a little careful. Late summer doldrums could be upon us. Let's see what we have. Trade the range for now. Don't get too excited. We could still have a little bit more downside. I know yesterday was a nice recovery day, but when you start downtrends, it doesn't mean you go down every day. Sometimes you do have bounce backs. So let's just watch the market. If we can't get through 64.27 and we start to roll back over again, just be careful here as we try to maneuver our way through August and September. Have a great day, everybody. Happy trading.